I welcome you to this session. In our previous lecture, we discussed about what is fundamental analysis, and in this lecture, we are going to discuss about types of fundamental analysis. Fundamental analysis can be grouped into two categories: quantitative analysis and qualitative analysis. Quantitative analysis includes the hard numbers. They are a measurable characteristic of the business. Hard numbers here means profit, revenue, and other financial statements of a company in rupees. Basically, quantitative analysis is related to information that can be shown in amounts. Quantitative analysis can be grouped into three categories: financial statement of a company, annual report of a company, expected ratio of a company. Now let me discuss about the financial statement. Financial statement are the medium by which a company discloses information about financial performance. Basically, it helps to know about the financial history of a company. Three most important financial statements are income statement, balance sheet, and cash flow statement. Income statement gives information about the revenue, expenses, and profit that was generated by the company over the year. Our second financial statement is balance sheet. Balance sheet represents a record of the company assets, liabilities, and equity. In simple word, balance sheet means balance in business financial structure. For example, asset is equal to liability plus shareholders' equity. Here, asset includes items such as cash, inventory, machinery, and buildings. Liability here means debt, which of course must be paid back. And shareholders' equity here means the total value of money that the owners have and the amount of profit made in previous year. Our third financial statement is cash flow statement. Cash flow statement represents a record of business cash inflows and outflows over a period of time. The cash flow statement is one of the most important factors for investors in financial analysis because it's very difficult for a business to manipulate its cash flows. Now we are going to discuss about second type of quantitative analysis, that is annual report of a company. Annual report is a document separate to the shareholders that gives the company's financial conditions and operation over years. Basically, annual report helps to know about future of the company. Important things to analyze while reading an annual report are as follow: vision and mission of a company, product overview and financial highlights, director report, management discussion and analysis. Now we are going to discuss about third type of quantitative analysis, that is expected ratio. Expected ratio of a company is a financial information that is reported quarterly or annually. For example, market capital, PE ratio, PB ratio, EPS, dividend yield, ROE, etc. Our next point is what is market capital. Market capital, it is the total value of a company share, and it can be calculated by multiplying the price of a share by its total value by its total number of shares. Market capital is equal to share price into total number of shares. Higher market price or market capital is good because it gives hint about how big company is. PE ratio. PE ratio stands for the price to earning ratio. It is used to find out whether stock is overvalued or undervalued. It relates a company's share price to its earning per share. PE ratio is equal to current price divided by earning per share. The lower the PE ratio is, the better it for business and investor. It should be ranged between 13 to 15. Our next topic is what is PB ratio. PB ratio stands for the price to book ratio. Traditionally, any value or under 1.0 is considered a good PB value. This indicates a potentially undervalued stock. The earning per share stand for the earning per share. EPS indicates how much money a company makes for earning share of its stock. Earning per share is equal to total earning divided by total number of share. Earning per share should be high because the higher a company's earning per share, the more profitable it's likely to be. Dividend yield. Dividend yield can be defined as the dividend displayed as a percentage is the amount of money that would be paid to shareholders. In general, dividend yield of 2% to 4% is considered as strong, and anything above 4% can be a strong buy. or a great buy. ROE can be defined as the return on equity. It is a measure of financial performance calculated by dividing net income by shareholders' equity. ROE is equal to net income divided by shareholders' equity. A high ROE is usually better. Now we are going to discuss about second type of fundamental analysis, that is qualitative analysis. There are three key fundamentals that analysis always consider when analyzing a stock or a company: the business model and competitive and management. Basically, qualitative analysis includes the quality of a company, executive brands and recognition and reputation. And the next thing is, if the company having a good management is the most important criteria for investing in a company, because the business model is fall down if the leader of the company fails to properly execute the plan. So the most important thing about the qualitative analysis is the management. Thanks for watching this video.